I thought, why do we have two different financial advisors? One's doing one thing, one's doing another thing.
We felt sometimes like we were being guided in directions to spend extra money on things that probably weren't always necessary for us.
I would not know for sure if I should put my money in here or put it in there. Should I buy this real estate?
Like, I don't know what to do with this money, and I don't want to just blow it and spend it.
We were concerned about our financial health and just wanted a better financial picture.
And so when Earned came onto our radar and we sat down with our financial advisor, it just felt different.
I think a physician specifically should look at Earned because the focus is on our field. They know what a physician goes through at different phases of our career. To have that knowledge in order to guide us, I think is just such an advantage.
Earned isn't just about giving us financial advice. They're about doing the things that are needed to be done in order for you to fulfill your financial plan that they have created with you. And that really was very meaningful to me.
Earned is kind of like the conductor of an orchestra. You know, you pull in the trombones, you pull in the trumpets, you pull in the percussion. But Earned is the one that's holding the baton. I feel trust that they were taking care of my entire financial picture, not just one little part of it.
As a physician, I know that what I do for people is really powerful and impactful, and it's important for me to know that the level of expertise that I'm working with for my financial health is there, and I have that trust for them.
It's definitely valuable because I don't have to go looking a million different places. Like, I don't have a lawyer over here, and I don't have, the insurance thing over here. Everything's under one roof.
Earned brings clarity to my financial life.
With Earned, I feel really well taken care of.
I feel my financial health is secure.
I feel supported.
Earned is security.
I would highly recommend any doctor to look at Earned.
I love what I do, and it's really important for me that my patients have the utmost trust that I'm taking the best care of them. I have that same amount of trust with my financial advisors at Earned.
Hello, everyone. Welcome. Thank you so much for being here today. Thank you again for joining us, even through some technological issues. We know how tech can be in this day and age, but again, we appreciate you being here. Hi, Jorge. Welcome. Glad you could make it. So we could kick off our 7 tax mistakes physicians make every year, brought to you by Earned and Physician on Fire. I'm Amber Eckerfield, Marketing Manager at Earned, and I will be your moderator for this webinar. Earned is a longtime partner of Physician on Fire and the first fully comprehensive tax and wealth firm built specifically for doctors, their families, and their practices. We bring tax planning, investing, retirement strategies, practice level advice, and now insurance and legal coordination all under one roof, so your whole financial life works together. Before we get started, a few housekeeping notes. That chat icon is at the bottom right of your screen. Feel free, say hi, hello, tell us where you're joining from. We're excited that you're here today. If you have any questions, the questions icon is at the bottom right of your screen, right next to that chat box. If you have a question during the presentation at any time, please enter your question and we will answer it at the very end of the presentation. We're excited to have Jorge and Carole with us today. Jorge, as many of you know, leads the Physician on Fire community and has long been a trusted voice for physicians pursuing financial independence and long-time clarity. Our speaker, Carole Foos, has more than 25 years of experience advising physicians and high-income professionals. Carole brings deep expertise in tax planning, retirement strategy, and financial decision-making for complex income situations. She has helped thousands of physicians navigate multi-income careers, practice ownership, and tax-efficient wealth building. In this session, she'll walk through common tax pitfalls physicians face and the planning opportunities many overlook, along with the practical steps you can now take throughout the year. So with that, I'm going to hand it over to Jorge to say a few words before we bring on Carole. Jorge, so glad to see you. Glad you
Hey,
made it.
hey, Amber, how are you? Hello, physicians. Glad to see you here at this webinar. This is an exciting webinar. This is 7 tax mistakes physicians make every year. I'm pretty sure that number is bigger than 7, but we're picking the biggest 7. The interesting thing about what to say is that mistakes with taxes are not catastrophic if you catch them early. Um, you don't have to have some exotic tax shelter that you screw up to end up losing hundreds of thousands of dollars. Very small mistakes that incrementally add up over time. Today, we're going to talk about these things. We got Carole. She's got over 20 years of experience. Ern has been working with physicians. They understand our complex business life. They understand the fact that we do side gigs, which can drive most of the CPAs crazy. So without further ado, let's get started. And I'm going to take my notes and make sure that I get ready. Excited to see you guys.
Awesome. Thanks, Jorge. Carole, we're excited to have you joining us. We'll let you take it away.
Thanks, Amber and Jorge. Appreciate it. And welcome, everyone. Thanks for joining and trusting us with your valuable time today. And I hope you'll find that it is a valuable use of your time. As Jorge said, I think one of the things I would start with, having worked with physicians for many years, is exactly what Jorge said. You don't have to do crazy things or take huge risks to reduce your taxes. There are a lot of pretty simple things you can do. It's a matter of paying attention. It's a matter of having coordinated advice and having advisors who understand sort of the nuances of what your income streams and your available deductions are as physicians. So I hope this will help today in pointing out some things that you should be doing. If you haven't already organized your tax documents for 2025 or haven't filed your returns yet. And in addition to that, some planning opportunities for 2026 and beyond. So I'm going to go through a lot of these slides. We will have some time for questions and answers at the end. So please put those questions in the chat box as you have them, and Amber will keep an eye on that for me. So first, 3 of the most common tax mistakes we'll start out with. Number 1, underpaying estimated taxes. For many of you, particularly if you've got a side gig and you've got 1099 income coming in, or you've got multiple W-2s, there is a tendency, particularly in a year where your income changes, right? You've just added a side gig, or that side gig has increased significantly in the amount of income you're garnering from it. We want to really stay on top of those estimated taxes to avoid penalties or to avoid an unpleasant surprise that maybe you get a call on April 13th from your CPA saying, you owe a lot of money and you really weren't expecting that. I would tell you one thing that I always encourage clients to do, and I don't any longer prepare tax returns for clients, so it's not a selfish ask, but I would say sitting down with your CPA and having planning meetings throughout the year to make sure the two of you are on the same page when it comes to what does this year's income and deductions look like? Where should I be in estimated taxes, right? And it could even be that your income's gone down from a prior year. Maybe you got rid of some of that side income and you're paying too much in estimated taxes, which can be a problem on the other end. We don't need to loan the government interest-free funds. So keep an eye on that. Work with your CPA to plan for proper amounts of estimated taxes. Overlooking deduction opportunities is a huge issue, particularly for those of you who have a business return at the practice level or a Schedule C for a side gig. Things like CME expenses, home office deductions if you're doing telemedicine or if you are regularly and exclusively using a home office. Eligible write-offs are often missed. And again, this is where it can become paramount to make sure that your CPA works with physicians a lot and understands and can point out to you some of the other deductions that you might be taking for your side business. whether that's taking travel costs for your auto miles if you're going between, location to location or things like that. Ignoring state tax implications is another problem, and we see this a lot. Those of you who are in a multi-state area where you're crossing state lines or you have offices in two different states, relocating from a fellowship to employed practice or relocating from one practice to another and not anticipating those additional state filing requirements can be a big mistake. Again, that can be a point where you want to be in communication with your CPA, because what a lot of people don't understand is if I move to a new state and I didn't file a tax return in that state last year, I don't have a safe basis for estimated taxes in that state. So I want to make sure I've got withholding right. I think along with that, I would say I often see as physicians are changing jobs or going into new jobs, keeping an eye on that withholding in the early paychecks of the new job also paramount. It can be off based on what you filed on your W-4, based on a new payroll system. So again, that's where I would tell you being in close communication with your CPA and having someone take a look at that if you're starting a new job or have new withholding is going to be important. Some key planning opportunities that you should think about before you file. So again, maybe you've already sent your information in to your CPA for your 2025 return. Maybe you're still missing some items. If your returns haven't been filed, it's a great idea to take a look back at last year's tax return and just see what were your sources of income. Have you received all of your W-2s and your 1099s and sent those to your CPA? Are there 1099s that you've added this year that you should have received and maybe you haven't? Looking at last year's return for carry forward losses or credit carryovers, things like, I sold some stocks and I couldn't utilize all my capital losses last year, so I've got to carry forward. Now, certainly, if you're using the same CPA that you used last year, they will have a record of those carryover losses. But it is important to note if you've got a new CPA this year, you want to make sure they've, looked at that prior year tax return and they have had a record of your carry forward losses and credits so that you get to take advantage of those on your 2025 tax return. There's still time to make IRA contributions and even to do a backdoor Roth for this year. So you can make those contributions prior to the filing deadline. For some of you, those might be non-deductible contributions. For others, you might be able to take deductible contributions. Either way, it's a way to bump up your retirement savings, and certainly working with a financial advisor who can help you determine whether it makes sense to then convert those IRA contributions to a Roth. Really a good key for wealth planning, down the road. And we work with clients all the time on this. You want to make sure you've got coordinated advice on that and really understand before you do those backdoor Roth conversions, how that works if you've already got a separate traditional IRA account, because you might be surprised that some of it's taxable and you didn't realize it. Take a look at your HSA contribution status. Did you maximize those HSA contributions for 2025? Did you use your catch-up contributions if you're over age 55? Again, a lot of people don't realize that. Often people also don't realize if you and your spouse are both over age 55, you each get a catch-up contribution. So just be looking at that, talking to your CPA about it if you're having your tax returns prepared right now, or thinking about that as, hey, I might be able to get a little more deduction if I need that for 2025. And then if you've got that business income, if you're reporting on a Schedule C, or you've got a pass-through entity that you haven't filed the return for yet, solo 401k or SEP contributions can still be made up to the filing deadline of the return. So that employer portion, profit sharing or match of a solo 401k or SEP contributions, which are considered to be employer contributions, you've still got opportunities to get some additional deductions for 2025, even now. So let's think about just a checklist for what should you be thinking about and planning ahead for next year. Adjusting your withholdings based on current year income projections. Again, if you got your tax returns back from your accountant already for 2025 and either you had a big overpayment or you owed a lot of money, this is the time to look at those withholdings on your pay stubs, send those to your accountant, determine, do I need to increase or decrease those? What's the best option for me? Also, keep in mind, a lot of clients really find it annoying to make quarterly estimated payments in order to pay the tax on those side gigs or that Schedule C income. You can adjust your withholding rather than making estimated payments. And one key point I will make about that, withholdings are considered to be paid in equally over the course of the year. So often, even if it's in the fall or late summer, and you've sat down and met with your accountant and determined you're in an underpayment situation, it can be better to adjust your withholdings up and have more withheld from a paycheck versus increasing your estimated taxes, because those estimated taxes, if you're not paying them until the third and fourth quarter, you might have a slight underpayment for the first 2 quarters, whereas upping your withholding at the end of the year, it'll still be looked at as though it were paid evenly throughout the year. Revisit your charitable giving strategies. Again, thinking about, we're going to talk about this. We have a few slides on this later in the presentation, but determining what's my best charitable giving strategy for this year and for the next few years. It's really important to consider bunching your deductions in order to itemize your deductions in alternate years. And this is key for those of you whose itemized deductions are maybe just over the standard deduction limit. Again, I'm going to show you a slide this afternoon that shows you how that can really bump up your deductions in total over a several year period. Coordinate capital gains harvesting with your wealth planner, with your investment advisor. So think about, if I've got realized capital gains this year, obviously thus far through the year, the market's been a little bit down. So you might be able to realize some losses now to offset capital gains that are coming to you later in the year, but you really want to work with your investment advisor on that and plan for that. Evaluate your investment income. Determine, really important thing, are your assets in the correct accounts? So are your assets that are generating a lot of taxable income in those retirement plan accounts where you're not paying tax on the growth year in and year out? You're either paying no tax if it's a Roth account, or you're paying tax when you take the distributions if it is a traditional retirement account. So, and then hopefully you've got more of your growth stocks, those that are tax efficient now and aren't generating a lot of taxable income, in your after-tax brokerage account. And if that's not the case for you, it's a great time to ask your investment advisor, your wealth planner, questions about how can I reposition those assets within my portfolio to make it more tax efficient. Think about making state tax deductible 529 plan contributions if you are currently saving for your child or grandchild's college education. Many states have some great deductions and credits available for 529 contributions. So even though they're not federally deductible, you can get some state benefits. If you have a business, whether that's a Schedule C, a partnership, or an S corporation, consider a pass-through entity election for your state. Many states have passed laws now that say pass-through businesses can elect to pay tax at the entity level. So my partnership pays the state tax on the business income, or my S corp does, or my Schedule C does. By doing that, you get a greater benefit of state income tax deductions federally. So those $10,000 or $40,000 state and local tax deduction limits that are placed on itemized deductions for individuals, depending on your income level. You can expand that a little bit by using a pass-through entity election on your business income. And as I mentioned before, look at a backdoor Roth conversion. Is that something that's going to help you out and make it better for you to plan for your wealth down the road? So we're going to think about all of those. Hopefully you've, jotted some of those down, made the list for things to talk about when you have those planning meetings with your CPA in 2026. So our fourth tax mistake that we're speaking about in this presentation is having the wrong entity structure. And I'm going to go through briefly what the different structures are from a tax standpoint. Important to keep in mind that your entity structure for tax is not necessarily the same as your legal entity structure. And what I mean by that is, as an example, an LLC is a legal entity structure, but LLCs can be taxed in each of these ways. If it's a single member LLC, it can be taxed as a sole proprietorship, or as an S corporation or C corporation. If it's a multiple member LLC, it can be taxed as either a partnership or an S corp or a C corporation. So I say that first. Also, I tell clients all the time, your current entity structure, you're not necessarily locked into that. There are ways to change your entity structure. Important to understand, if you are purely a sole proprietorship, so not an LLC taxed as a sole proprietorship or disregarded entity, but a sole proprietorship, meaning those 1099s come in your name, you're filing a Schedule C on your tax return. It's certainly the simplest. You don't really have to do anything or have any legal entity set up. However, you have full personal liability if you're structured in that way. Every dollar of your net income is subject to self-employment tax. So Social Security tax up to the limit and Medicare tax unlimited. I would tell you from an asset protection standpoint, as a physician, not how you want to be taxed, or not how you want to be legally set up, I should say. I would tell you, certainly, even if you determine that being taxed as a sole proprietorship makes the most sense for you, set up an LLC, have a single member LLC that can be disregarded for tax purposes. You can still file that Schedule C on your tax return, but it does provide a level of asset protection. A C corporation, right, is if I am an LLC and I determined that I want to be taxed as a corporation, absent an election to be taxed as an S corporation, I default to being taxed as a C corporation. Many of you who are owners of practices that have been around a long time, or practices that have a lot of owners, you might be a C corporation. Now, with a C corporation, there is a risk of double taxation. What I would tell you is many, many medical practices get around this double taxation by essentially bonusing out to their owners sort of the leftover net income in the practice at year end. C corporations have the greatest ability to deduct fringe benefits for owners, so that's a benefit. You do have to file a separate tax return for a C corporation, which you don't have to do for a sole proprietorship. But you want to, with a C corporation, you really have to manage to that double taxation risk, because if you don't, and you leave net taxable income in the C corporation at year end, you pay 21% corporate tax on that net income. And then in order to get the money out to the shareholders, you're going to be taxed on that income individually as dividend income. So reduced qualified dividend rates, but still, if you're in the highest tax bracket, right, you're paying tax on those dividends, 20% tax on the dividends, plus the 21% tax on the C corporation income. So potentially 41% tax, versus a pass-through where you're maybe only paying 37% tax if you're in the highest tax bracket. S corporation is a pass-through entity. In an S corporation, you do have to pay yourself as an owner providing services reasonable wages, and you'll receive a W-2 from the entity. So if you're a single owner, right, that can add some cost to you because you're probably paying a payroll service provider. But an S corporation allows you to save some money on Medicare taxes, because if I'm a C corporation and I have avoided that double tax risk by taking bonuses out through my wages, I'm paying Medicare taxes on all those bonuses. As an S corporation, I have reasonable W-2 wages on which I'm paying Social Security and Medicare taxes, but on my net income from the S corporation, that's not subject to that Medicare tax. So I can get profits based on the work that my employees do, or other work, and not pay Medicare tax on it. An important note for tax savings. Partnership and LLC is another way that a multiple member LLC can be taxed, or a general partnership can be taxed. Great thing about a partnership, or an LLC taxed as a partnership, is you can flexibly allocate expenses. So a lot of medical practices do this, where you're allocating the expenses based on sort of an eat what you treat mentality. Or there's also ways to allocate debt. So depending on how the practice was set up and how the debt is set up, for many people, a partnership will make more sense than an S corporation. Often, I will tell you too, if you've got a practice that can be bifurcated into sort of two separate businesses. Think, for an example, an ophthalmologist who has the ophthalmology practice and then also sells, eyewear, lenses, etc. They might have those two entities, separate that into two entities and have it taxed in two separate ways to take advantage of both entities and how they're taxed. So that can be very helpful. Mistake number 5, lack of diversification. Something I talk to clients about day in and day out, because here's what I often see. Clients who want to, right, get all of the tax deductions today, and I understand that. So maybe they're putting all of their, savings into qualified retirement plans, which are defined contribution plans and defined benefit plans. But what I really like to see as a wealth planner is people saving money into each of these 3 buckets as they approach retirement. So think of it like this. Your ordinary income bucket is the bucket that's your wages, it's your flow through income from the practice. It's your distributions in retirement from traditional 401k, 403b plans, traditional IRAs. That capital gains bucket, or the yellow bucket, is going to be your after-tax brokerage account. It's what happens when you sell your building, or you sell a surgery center, or you sell the practice. That's taxed at a maximum rate right now of 20% for people in the highest tax bracket, or 15% if you're not in the highest tax bracket when that gain is realized, versus, right, ordinary income, top rate is 37%. The blue bucket is the tax-free bucket. That's going to be things like Roth retirement accounts. It's going to be if you've put some of your money into a permanent life insurance product and you're planning to use the cash value in that insurance as supplemental retirement income. Obviously, that's got a 0% tax rate. So what we like to see is money in each of these 3 buckets, so that when you are in your retirement years, you've got the ability to pull from each bucket to manage your tax bracket. So if I'm pulling a certain amount of money out of my ordinary income bucket, out of that traditional 401k plan, but I want to stay in, let's say, the 24% tax bracket, and I need more money this year. I've got a child getting married, whatever. I'm buying a vacation home. I'm going to try to pull the additional money out of that capital gains or that tax-free bucket, because I'm trying to manage my tax rate in retirement. By the same token, we have no idea what tax rates are going to be moving forward. We're at the 4th lowest top tax rate in the 112-year history of the Internal Revenue Code. Chances are that top tax rate could be higher when you are in retirement than it is right now. So again, in years of high tax rates, having money in each of these buckets allows you to manage your taxes and better plan your retirement living. So mistake number 6, I mentioned this earlier, donating inefficiently. So for high income doctors who have appreciated investments and are charitably inclined, certainly think about donating those appreciated investments to a charity rather than donating cash. So what this does is it allows you to deduct the fair market value of that investment at the date you donated it. And you've never paid capital gains tax on the appreciation of the investment. It's a great tool. This ability to do this has been around in the, almost 40 years that I've been practicing. So let's give an example. Let's say you have $100,000 of Apple stock. That's the current value of the stock today. And you only paid $40,000 for it. So you're sitting on an unrealized $60,000 of capital gain. If you give that $100,000 of Apple stock to the American Cancer Society today, you're going to be able to take a $100,000 deduction on your tax return. If you instead sold the stock and then donated to the Cancer Society, you would have realized that $60,000 capital gain. If you're in the top tax bracket, you would have paid $12,000 of long-term capital gains tax on that $60,000 of capital gain. Plus, you would have paid state tax if you're in a state that taxes your income. So you can't donate the same 100,000, right? The charity, when it receives that 100,000 of stock, they can sell it the next day and they're not paying any tax because they're a not-for-profit. And you can use this method also to rebalance your portfolio and say, okay, too heavily invested in Apple stock right now because it's gone up so much. I'm going to give 100,000 of that away. I'm going to replenish my portfolio with my 100,000 of cash. Much more efficient way to donate to charities. Another strategy for tax efficient donations is establishing a donor advised fund. So one thing that a donor advised fund, there are a couple of times that I find this is very useful. Certainly, if you've got a liquidity event or you've got a year where your taxable income is abnormally high, that's a great time to establish a donor advised fund. When you move money or appreciated assets into a donor advised fund, you get the deduction in the year that you contribute those assets to a donor advised fund. Okay. Now keep in mind, the assets are then gone for you, but you have control over that donor advised fund and can spread the way that fund donates to charities over the next several years. So you can say, hey, I normally give $10,000 a year to the Cancer Society. I'm going to put $50,000 into my donor advised fund this year in 2026. I get that $50,000 deduction, and I'm going to spread over the next 5 years. The donor advised fund will give $10,000 a year to the Cancer Society. So again, you can put cash or appreciated securities in. It's obviously a great play to put appreciated securities in for the reasons I just mentioned. You can control the timing of the grants out of that donor advised fund. Also, a donor advised fund is invested, so as the market grows, what's in that fund will go up and you have even more dollars to donate down the road. Let's just look at how that works in action. So in this hypothetical example, let's just say you typically give away $44,861 each year to various charities. In addition to that, you have itemized deductions of $6,887 a year for your state and local taxes, whether that's property taxes or income taxes. Now, standard deduction of $29,200, that's gone up a little bit this year. But in this situation, each year on your tax return, between the gifts and the taxes, you had a $51,748 net deduction. So the total gift that you gave to charity was $269,166 over this 6-year period. And your total deductions were $310,488. If instead I bunched those gifts and made donations every other year to my donor advised fund, still giving away the same amount, I'm just doing it differently over 3 years, instead of 6. I still have that same deduction for taxes that I had on the previous slide. But now in the years where I'm not giving to charities because my donor advised fund is doing the donating, I'm taking that standard deduction. So I'm getting the $29,200 standard deduction each year, meaning I've increased my total deduction to $377,427. So again, charitable gifts are the same, but I've increased my deduction by almost $67,000 over the course of the 6 years, reducing my taxable income. Another great tax efficient way to give money to charities is through qualified charitable distributions, or QCDs. Now, these are available for taxpayers age 70 and a half or older, and it is a way to donate to qualified 501c3 charities directly from your traditional IRAs. So what a lot of people use this for, right? You can don't start this at age 70 and a half. Current year when individuals, or age when individuals have to start taking required minimum distributions is age 73. So by giving away to charities directly from your traditional IRA, you're reducing that required minimum distribution at age 73. The qualified distribution amounts are completely excluded from your taxable income. So they never even show up as, pension income or IRA income on your tax return, which also reduces your modified AGI, which has other benefits. It satisfied the required minimum distribution. So as an example, if my required minimum distribution is $111,000, I can give that full amount to as a qualified charitable distributions, meaning I don't have to take a required minimum distribution at all. So it lowers your AGI. It's giving to charity in a tax efficient way. This year's limits are $111,000 per individual or $222,000 per couple. So for those of you age 70 and a half or older, or maybe some of you have parents age 70 and a half or older, it is a great tool for making charitable donations efficiently. So important to note, and I know this is small on your screen, but gifting the right asset is important. Donor advised funds have to be to a qualified charity. They have the potential for growing. Those investments will grow. You can put appreciated securities into that donor advised fund. The limit is 60% if it's a cash donation, so 60% of your adjusted gross income, or 30% if it's appreciated assets. Keep in mind for private foundations, those also have growth potential. Those have greater reporting requirements, as if you establish a private foundation, you've got to report that on a Form 990-PF every year. Your limits for donating to private foundations are lower. It's 30% of your adjusted gross income for cash, or 20% for appreciated assets. And then charitable life and remainder trusts, also great tools. And they can also grow. You can donate non-cash assets. And it sort of depends on the charity that's supported as to how the deduction works. Check, cash, or credit, public charities, no growth potential, no donation of non-cash items. You can also write a check or pay cash to a private foundation, but instead of a 60% deduction for that, it's limited to that 30%. So just something to keep in mind. The key thing here is work with your advisor on your charitable giving. Think about how you can do it smarter. There are ways to confirm your charity's eligibility. So know that whether it's a 501c3 organizations, if it's not, kind of a known, like I said, I mentioned the Cancer Society, right? If it's more of a local charity, there are ways to check the IRS TEOS database to see if it's a 501c3 charity. Make sure you're getting documentation. That's important. And then we're up to mistake number 7. So I want to make sure we get through this and have time for your questions. Mistake number 7, and I really do think this is a big one, it's no oversight on your investment portfolio. So, some things that you can do within your investment portfolio to make it more tax efficient. One thing is custom indexing, which allows you to own individual securities, which would typically be bundled in a mutual fund or an ETF. And what that does is give you greater control over the investments, and it really does enable targeted tax loss harvesting. And I think that's really important for many physicians because what we're seeing over the last several years, right? A lot of sales of physician practices to private equity or to bigger entities. So, by using technology to capture tax losses through direct indexing, you can sort of bank your losses over a several year period and then have those losses offset gains in non-investing accounts. So let's just say I own the building that my practice is in. I know that the plan is to sell that building 5 years from now. If I start using a direct indexing strategy and building up some of these gains, then in 5 years, when I sell that building, I can offset my capital gain from the sale of the building with these losses that I have built up. It's really an interesting tool. Um, it can allow you to more rapidly offset capital gains, even if, I don't have a 5-year time horizon. There are a lot of different ways to do this utilizing a long, short equity portfolio. And that has the potential to realize larger net capital losses compared to only long term equity portfolio investing. So again, a great thing to talk to investment advisors about. We do have a case study that I just wanted to quickly go through with you. This is an earned client, a 67-year-old orthodontist in the San Francisco area. His annual income from the practice was $400,000 a year. And he worked with an earned wealth advisor to use this tax loss harvesting strategy to achieve losses, and then sold the practice and realized capital gains. And he was able to utilize those built up losses to offset the sale of the practice. So he funded $1.7 million to this account in 2023. He sold the practice in 2024 for $1.6 million, and then he invested $1.1 million more. He harvested a total of $1.4 million of losses in 2024. So again, it can really be powerful as a way to offset capital gains. And just, from work that we've done and studies that we've done and cases, an extra 1% of tax alpha can potentially add up to 11 additional years of retirement distributions to your portfolio. So again, tax efficient investing, one of the most important tools you can utilize when it comes to planning for your wealth in the future and really working to minimize taxes. I wanted to go over this. I think it's really important to have coordinated tax planning to help you meet your long-term wealth goals. And that coordination, right, as we've learned today, it's tax strategy, it's wealth planning, it's having an annual review, it's thinking about things like risk protection. We talked about that, asset protection, and how your entity is structured. All of that coordination is important and is much better than a siloed approach. We want to make sure your advisors are talking to each other and working with each other on these common goals. Because what I will tell you is I have seen it, it's hard for you as the individual to, right? It's not necessarily your area of expertise when you're talking to your investment advisor or you're talking to your CPA. They're telling you things. It's not what your educational background has given you a wide berth of knowledge on. So sometimes things get lost in the translation when you're going from one advisor to the next. Whereas if your advisors are working together, it's a lot easier for them to align and help you meet your goals. So just as an example, in the siloed approach, your CPA might recommend maximizing 401k contributions. And then you've got your wealth advisor suggesting Roth conversions. So sometimes these strategies can conflict, which is why it's better for those two individuals to be working together. At Earned, we would have the tax specialist and the wealth planner collaborate, and work together on a client to make sure what's the best strategy for that Roth conversion and putting money into the 401k or the defined contribution plan. We feel that that is the best way to align the strategies and save taxes over the course of your lifetime. So having the best specialized advisors aligned and connected will be the best way to help you plan. There's a QR code on the screen. You can scan that QR code to book a meeting today. Maybe not today, but certainly in the very near future. And also on the screen, just a little bit, I know many of you are familiar with us, have been on these webinars previously, but just shows you how Earned can help work with you and your practice in many different areas.
Thank you so much, Carole. Gosh, I feel like every time I'm on these webinars, I learn so much. Thank you for adding so much value and clarity for taxes. And I really hope everyone really gained a lot of knowledge. Maybe they found some mistakes that they need to fix immediately. And again, we can help you do that. We also want to give you what you, not only just when you came for as the advice, but that checklist that we created for you. So if you look on your screen under apps and handouts, I have a checklist, a 2025 tax checklist for you that you can download. That is your free giveaway from us that we have created based on everything that you need to take in account while doing your taxes every year. So please download that, use it. Give us feedback. Let us know how you're using that or how it's helped you to make sure that you are maximizing your tax benefits. So I'd love to get Jorge back on the screen here as well so that we can answer a few questions. And I'll pull those on the screen. Again, like Carole said, book a consult with us today. We have the link in the left-hand corner. Download that checklist in our handouts app area, also on your bar. Welcome back, Jorge. Before we dive into questions, what do you think? Are you prepared to file your taxes, or did you already file?
I'm working on it. So I'm actually have to make a couple of adjustments. I think the big thing about this is that I believe in FD/BD, for physicians, by physicians, is Earned. The challenge with physicians that we're running around, some of us are DIY, we do it ourselves. Some of us don't have the time and we make mistakes. And I've heard this from sitting across many tables in many hospitals over the last 10 years with many physicians, is that it's not one mistake, it's just a lot of little mistakes that are additive. That's one of the big things. The other part is one-stop shopping. Every year the tax code changes, and when I just realized I couldn't do it anymore. At one point I had to really work closely with my accountant and my CPA because the code changes. I was moving. I'll give you an example. I lived in Arizona, and I was doing side gigs in New Mexico, and I created an entity in Arizona, and then I moved to Florida. And the mistake I made is in the moving and just all the drama of getting a new job, transferring, worrying about the dogs, moving the cars, the couple of cars I forgot, and I did not set up a new entity. And then when I came to to Florida, where I live now, I just kept my old entity. And I realized I had moved from a state, which is Arizona, to Florida, which is a non-state. And I lost, I think it was $59,000, because Arizona claimed me and said, "Hey, you're still getting 1099s through us because it's entity," and I'm down $59,000. So we just have to be humble and and accept that we live very complicated lives as the usual, compared to the usual person, and a lot of little mistakes and add up to a lot. I think we have some questions. Also, by the way, the people who are late. or you have to leave, we're going to get you an email with the link and I think the giveaway, right, Amber?
Yes, absolutely. Sending that recording link and providing that PDF checklist so that they can utilize that as well. So if you can't get it on here, no worries. It's going to be sent to you automatically.
And one question is when they go back to see the link, do they have to re-register? How does that landing page, so they just, it can be set up so they don't get confused?
Absolutely. Yeah. So to clarify for everyone, if you ever want to come back and watch this webinar, just re-click the link that you used to get in here in the first place. And that will allow you to bypass registering again. That is your personal registration link that you can access the webinar and view on demand anytime. As Jorge mentioned, we also send those emails out with a link to our YouTube version of this recording, and we will be sending that checklist. If you ever have any questions, please always put it in the chat and I can help assist you, or you can email me at amber.eckerfield@earn.com. I'm happy to provide you any marketing help with that. Without further ado, let's get some questions answered. So Carole, I'm going to put this on the screen for us. If I'm contributing to a DBP with 1099 income and I'm about to reach the end of it per my actual accountant, 1.2 million, will I need to pay quarterly estimated taxes beginning next year, or should I take more out of my W-2 income throughout the year? Let's see if we have an answer for him.
Do. So you can certainly do either. What I think is key is if you're going to pay the extra via quarterly estimated payments, you want to make sure you're starting that in the first quarter. So with that first April 15th payment. If you don't, or let's just say, you don't fully fund it this year, and so you get your 2026 taxes done and you find out, maybe you've extended those and that's when you find out, oh no, it's fully funded. I'm not going to be able to do this next year. Now I've got to make up for those estimates. That's particularly when, to the extent you can increase your withholding, you want to do it, because even if I just really bump up my withholding in October, November, December, the IRS will look at it as though that withholding was done evenly throughout the year. So it'll avoid some of that underpayment in the first 2 quarters. So really up to you, but I just would encourage you, if you know you're going to need to make estimated payments, get that calculation done so that you're making them in the first quarter or starting them in the first quarter.
Wonderful. Thank you so much. Hopefully that answered your question. Again, if you have more questions, you can always put another question in the chat. All right, next question. If both spouses are over 55 and the entire family is covered under a family HSA, can the other spouse contribute the extra $1,000 to their own separate HSA, even if it's a single person HSA established at a different company, or does it have to be another separate family plan?
I believe they can set up a single person. What you really want to make sure of is if the whole family is covered as under high deductible plan, that just as a whole between those 2 plans, you're not exceeding the annual limit with the 2 catch-ups. But you can have multiple accounts or multiple HSA accounts. So.
Wonderful. And again, if you have a more specific question such as that, feel free to reach out to us so we can actually dive into your HSAs a little bit deeper. All right, next question. Here we go. What if I don't have any large gain in the future? I don't own my own practice, plan on staying in my house forever. Is there any other reason to have direct indexing to accumulate large losses? What examples have you seen?
So I think another reason to do it, honestly, is just to offset gains within your investment account. What we've seen with a lot of our investment clients, right, over the last several years, the market's been very healthy. A lot of people are sitting on large concentrated gains. And maybe they want to be able to rebalance their portfolio, but they don't want to pay tax on those gains. So that would be another reason to use that direct indexing to build up some losses just for periods of time where it makes sense to rebalance your portfolio and you don't want to have those large capital gains. And obviously what you the amount you put into the direct indexing, right? You're going to work with an advisor on what makes sense for you given what you're looking at down the road in terms of potential gains. But even if it's, hey, I've got all these, stocks or ETFs, whatever it might be, that have built-in gains already, I'm avoiding selling those because of those gains. It might be a good way to efficiently build up some losses and avoid paying tax on those gains.
Sounds like, Ricky, you are hitting fire, which is super exciting. Love that. All right, next question. Even if I am in the highest tax bracket and still working, is it a good idea to still do Roth conversions?
I'm gonna pretend I'm a lawyer and say maybe. So I would really say for that, it might be. I think a lot of that depends on your age. What is your bucket? What do those buckets of income look like for you? Are you saving for, what do your savings for retirement look like? Is everything in that ordinary income tax bucket, or most of it, where everything's going to be taxed at ordinary income tax rates in the future? I didn't really mention this, but what we find with our clients, right? High income taxpayers, you're not likely to drop to the 15% tax bracket in retirement. You're probably going to be, certainly in your early years of retirement, still in one of the higher tax brackets. So my belief is you still want to get some assets in that tax-free bucket. And if you can do a Roth conversion where it's not really costing you anything. So think about that backdoor. I put money in my IRA. It wasn't deductible when I put it in. I'm immediately converting it. There's really no tax impact of that. So yes, I would say it could still make sense, but it is, we have to look at it individually.
I have a comment on that. Actually, we did a webinar, Amber, with Earned on Roth conversions. We actually did 2 webinars. So it was a lot, and I learned a lot.
Yeah.
I think that the reality of that, Carol, is that 80% of physicians in the U.S. are W-2. So
Mhm.
if they're employees of a clinic or a hospital, if your hospital employer has a 403B or a 401k plan, it does allow after-tax contributions within
Right.
Plath Roth conversions. And then you may end up qualifying for, what's called the mega Roth, the mega backdoor Roth. I think the homework for the physicians here, because a lot of them we don't ask, is get on the phone, call your benefits office or your human resource and say, hey, does our plan allow after-tax employee contributions? And then the second one is, does the plan allow in-plan Roth conversions? And if the answer is yes, then you have a significant tax-free savings vehicle sitting right there that you need to execute, and you need to talk to an advisor to get you to go through that. So that's number one. And number two, I think that the key part is, again, complexity. The more complex your life is, the more the easier it is to make a mistake. And therefore, what I liked about Earned is that, again, they talk to each other, and all these dependencies, they can unlock dependencies that otherwise, if you didn't sort out what you would do. I'll give you an example, a sequence. If you do one sequence of a financial transaction in the wrong order, it's going to hurt you. So that's part kind of my comment on this.
Absolutely. And you're right, Jorge. We've brought a lot of experts onto our webinars, and they all have various backgrounds and expertise and perspectives, and have worked with a wide variety of physicians and doctors. And so that really makes Earn super unique, which we love, right? We want to make the best life for our physicians, since they help us stay healthy and lead us to our best lives. So any other questions that we can answer for you, or key takeaways, Jorge?
Any questions? If not, I can give you some key takeaways from this.
Let's do it.
So takeaway number one, tax planning is a year-round vital sign. It's not an annual event. And the mistake we do is we just put our heads down. For example, I used to be a hospitalist here in Naples. It's very seasonal. In Arizona, it's very seasonal. New York is very seasonal. And in the winter months, you're just hammered, and you just put your head down and you don't look up, and you just work. December comes, and comes and goes and you miss a lot of deadlines. So you shouldn't be doing all these last minute things in April. You should be doing them early in the year. And you should be reviewing withholdings, look at your estimated payments, retirement contributions, look at a charitable strategy throughout the year, which Carole just reviewed. Just don't wait for the crisis to show up before you order a workup, like we say with a patient. Key takeaway number 2 is every dollar has a tax character, and where you put it matters as much as how much you save. So ordinary income tax, it's 47%, capital gains at 30, tax-free at 0. These are 3 buckets that you need to be constantly thinking about and acting on them. And we saw those numbers, and Carole ran those models, and those are not subtle. Those are a big difference. The next one is, you need to have your advisors talk to each other. The tax law changes, even what state you're on changes. I'll give you an example. If you get a new job in July, that means you worked half of the year. For example, for me, half of the year in Arizona, or California, if you were to make it, or New York to California, you go from a high tax state to a low tax state, or no tax state. That 50, now you have to make big strategic decisions about that move and how you're going to attribute that money, especially if you do side gigs, medical directorships, side gigs. All this stuff is income that we can get, and sometimes we lose track of it and make very easy mistakes. And that's why it's important that your advisors talk to each other, so that they can figure out where your leaks are and plug them through these vehicles that they offer. And I think that's it. I think the big thing is just stay on top of your keep track of it. It's not a lot of work. You just have to pay attention a little bit in a while. We worked with Earned for 2 years. We have developed a mobile app with them that carries our content. You could look at your finances in there. It has pillar content about all these things that we talked about in these webinars. And all these webinars can be found in the content that we create for Physician on Fire. So again, thank everybody for stopping by. Don't let the word tax raise your heart rate above 100. Stay healthy, and we'll see you guys next. Thank you, Amber. Thank you, Carole. Much appreciated, and we'll talk to you guys soon. Have a good one.
Thank you so much.
Thank you.